Systems work, people fail. Welcome to InsureMark's Advisor Mentorship Podcast with Vice President Jeremy Hauser.
Innovation in an industry is inevitable to thrive, but how can advisors take advantage of volatility in the financial space? Welcome to this week's episode of the Advisor Mentorship Podcast. I am your host, Jeremy Hauser, and today our guest has spent over the last 20 years serving in senior leadership roles at BATS Global Markets and LiquidNet, product management at Citigroup's Lava Trading, and market making at Knight Capital before becoming founder and CEO of Salt Financial. Our guest is Tony Barchetto. How are we doing today, Tony?
Good, Jeremy. Thanks for having me on.
Hey, thanks for joining, especially last minute here. And I think for the audience that maybe has never heard of Salt Financial, I know some of our partners have started to utilize your team here over the last couple months and couple years now. So why don't you share with the audience a little bit about who is Salt Financial?
Sure, happy to. Salt Financial is an index design firm that really focuses on the annuity market. We're probably best known for our truVol, which is our volatility control mechanism using historical intraday data, which I think we'll talk a little bit about in a few minutes. But in addition to that, we also do a lot of other parts of the index design process. And the way that we do that is by working with partners. We're in 10 different annuity indices right now, which people probably don't know because we're not always the top line story. A lot of times we're working with a partner like a NASDAQ, an index provider, or an asset manager like an Invesco or a Franklin, or I think we have 9 investment bank partners now. So it's really us combined with the partner, and we do our volatility control and our index design, and combined with really that kind of great brand and some of the strategies and benchmarks that are available at the partner, bring that together to create volatility controlled indices for this market.
And specifically for annuities, you said, right? So how long have y'all actually been in the FIA space?
We launched our first annuity FIA in early 2021. So it's just been about 3.5 years, but we've been around a little bit longer than that. We actually started in the ETF market using a very similar form of our vol control in ETFs. And that worked well. But what we found is that in vol control, where you had to rebalance every day and you had this real need for a really accurate vol control, that was way more important. So we just started spending a lot more time on FIAs. And until recently, it's been 100% of our time. And now we've kind of branched out a little bit. We're starting to get kind of tack back to the advisor market a little bit. We launched our first RILA just about a month ago, and we just launched a structured note recently with a NASDAQ index. So, but really all around that kind of risk-focused market, using our risk analytics in index products is where we're focused.
And actually, Tony, a lot of our advisors, so a lot of them that listen to the show, we have a pretty good relationship with a group by the name of the Index Standard, and they do a lot of, I'm sure your team's familiar with them.
Yeah.
Right. Yeah. So they do a lot of what's called forecasting. And I think a lot of advisors nowadays, especially where the rate environment is with these products, and as we look back, and that's where the industry in whole can get in trouble, depending on past performance, but now including new rates, so high rates on these particular products. So that forecasting component has become really valuable to the advisors that we at least work with that help out with the FIA space. So when y'all do research, and do y'all have like an actual process for your own forecasting, and how does y'all's team actually approach forecasting in the FIA space?
Yeah, I mean, we have kind of 2 guiding principles, right? Number one is really making the prediction horizon very, very short. What I mean by that is we're looking to predict volatility just 1 or 2 days in advance, which is kind of a lower bar. It's a lot easier to do. We're not looking to predict return. We're looking to use intraday data, so more data, and look to predict very short term. I mean, probably taking it out of the annuity world, looking elsewhere. I think everyone's looked at a 10-day weather forecast, right?
Yep.
For the rest of today, it's dead on accurate. And then out, 1, 2, 3 days, it's pretty good. You look out over a week, and that day 6 or 7, it's rain or shine, you might as well throw it out. A lot of things can change. So we really shrink that horizon and make our job a little easier to forecast volatility day to day, and then bring that into the process to be able to adjust the exposure, whatever the underlying asset is, to help drive performance. That's number one. Mm-hmm. Number 2 is kind of related. Look, I mean, if you ask me where the S&P is going to end up next year, I have no idea. And I think a lot of people, it's really hard to do. Prediction is really tough. So what we like to favor in an index design is making it more adaptive, meaning let the market tell us what's going on. And we can do that with a couple different tools. So for example, instead of saying we're going to put 50% in this asset and 50% in that, we're going to let the risk determine, hey, which one's more volatile now? What's the latest reading? How can we use that in the allocation process? When we're doing multi-asset indices, if we're going to allocate to bonds or commodities, we'll use a simple momentum filter to let that tell us, hey, is this a good time to have this as an asset in the index? So making it more dynamic and putting that in index rules, because these are really long-term products, right? You have separate surrender periods of 7, 10, 12 years. A lot of times people are going to be in the index for quite a while, and it's going to be a market cycle. So we try to put features in there in the rules that allow for that change. So short horizon forecast and adaptable rule sets, and that's kind of how the way we manage some of the uncertainty in terms of the index design.
On the overview, so if we actually look at the industry itself, so for Sol Financial, so why annuities? So like why now? So the last 3 years, you guys are now making a big splash into this space. So what got you excited in starting SALT and specifically focusing on annuities?
So we had this idea of using intraday data and indices for quite some time. Predated the annuities. It started with those ETFs. I used to work at stock exchanges, so dealing with intraday data and having things move very quickly and respond to that is something that comes second nature to me. We thought this would be applicable to the index market. If you could get a better sense of volatility, volatility is so linked to return. As you get a higher volatility, returns tend to go down. If you can predict volatility, you can improve performance. So we really, as we were pivoting from the ETFs, and this was credit to some members of my team who had experience with this, saying, hey, you know what? We can take this exact same technology, and this looks really similar to what I was working on in risk control. We did that. We developed it for about 6 months to 9 months, and we said, yeah, this is. We work with partners on that. Let the investment banks tell us how well can you price the options. How does this improve the hedging? How does this improve the performance? And it was a very organic process of working with partners to get we can just plug what we were doing here, but it's much more applicable to the annuity market. Again, because you're rebalancing every day, and it's very reliant on a high quality volatility forecast, which is what we had through the use of this intraday data.
So kind of that was a good overview of where Sol Financial fits in. So you guys aren't technically designing the index, but you are building on the current index and how to make it better, if I'm hearing you correctly, right?
I would say we use the underlying components, which may contain a full-fledged index that we add truVol to. Or a lot of times we work with the partner and say, all right, it's an Invesco equity component with a fixed income model that we built with our vol control, and then we collaborate with them to build the index. So we don't sponsor any index. You won't see a SALT index. It'll be the partner, but we collaborate on the design. It's the volatility control, but also the other things that we add, especially on the multi-asset. How are you going to allocate these assets? That's where we're going to bring our risk analytics in, because it could help add value.
And a lot of advisors nowadays, they look at, the benchmark, I would say, Index Standard uses it, and a lot of advisors out there, they look at the S&P 500, NASDAQ, obviously, been in the news a lot lately. And especially we've had some great performance in that. So how do you decide, who you want to really just partner up with, and then moving forward when it comes to indexes similar to S&P, NASDAQ, or what do y'all look for what's a good fit for y'all's model on the vol controlled index?
Yeah, I'm definitely going to spend some time about NASDAQ. I think it's a unique case, but one of the benefits of being able to partner with everybody is that we get to diversify our products as well. So we can take, a technology index, we can work on a low volatility index, so we can work with different specialties, which is, I think, an advantage the way we work with partners. But with respect to NASDAQ, for example, we thought NASDAQ as an index, the NASDAQ 100 in particular, was really ideal for the FIA market. You mentioned the performance. It come into the year, I think, 12 of the last 16 calendar years coming into 24, the NASDAQ had outperformed the S&P 500. And look, anyone's guess whether that's going to continue, but it's our belief that as long as NASDAQ continues to attract those innovative growth companies, it's always going to be an interesting place to invest. And furthermore, if you look at the FIA, it's a very unique structure, right? Zero is your hero. Yep. If you have a more volatile asset like a NASDAQ 100 and combined with risk control, the worst you're going to do is zero in that year, unlike when you have it in a brokerage account. So if you buy stocks and it goes down 30%, right? You got to get up 43% just to break even. But if that happens during your crediting period and then you zero out, you have the ability to start from zero and be able to, get the opportunity to earn credits. So for something like NASDAQ, where you do get, time to time, technology stocks do sell off, but there's always interest in technology stocks. They come bounding back. You can have the opportunity to participate in that. So we were really excited to partner with NASDAQ for that reason alone. We just thought it was very unique appropriately positioned for FIAs.
And why do you think there's not as many NASDAQ out there in the FIA space? So I think outside of maybe just everybody's making some fast convergence index of the NASDAQ, but
Mhm.
why it seems like people were kind of late to the party of designing it. Is it just expensive, or a little more inside baseball than I? So
Yeah, I mean, it's a little bit of inertia. S&P had quite a head start, and we partnered with Nasdaq to kind of help catch up. We're launching a lot of products with them, so they were able to enter the market instead of just doing the version 1.0s. They partnered with us to do the more modern intraday versions right from the start. But to answer your question, I think part of it also is a bit demographics. You look at the maybe 10 or 15 years ago, the folks that were investing in Nasdaq stocks that were maybe 30 years old 30 years ago, they've been invested in Nasdaq stocks their entire lives, and now that they're moving into retirement, it's a little bit of not much of a stretch to say, hey, why don't you have a Nasdaq allocation? So I think even the age, the population has really kind of grown up with them, and that's part of the reason that you're seeing it be more popular.
I think it's safe to say, just by listening to the last couple minutes, your team on a forecasting metric, S&P 500 or NASDAQ, you guys are going to be partnering a little bit more with NASDAQ just to diversify the portfolio, or is that where you see better opportunity in the FIA space?
So, I mean, we have other index partnerships. We've partnered with MSCI. We partnered with a number of asset managers. They're going to have a little bit more of a broader market approach, different kind of maybe factor tilts or, styles that they're going to have. We have some sector models. So it's the technology that we have, the kind of toolkit, we can adapt to pretty much anything. The NASDAQ partnership is pretty key, but we do have a pretty diversified lineup. I think now maybe 3, 4 asset manager indices, and now a few with banks too, where banks can bring in some interesting things that they have, like intraday momentum or commodities overlays, things that expertise that they have, and we can partner with them to work on those types of multi-asset indices where we don't necessarily have the expertise in-house.
Yeah, and so with all the data that your team does collect, what do you say, or when are times that the single asset could actually be more favorable compared to the multi-asset?
Mhm.
So two questions. So when is it a single asset a more favorable time than a multi-asset, and then where do you see we are today in a forward-moving environment?
In terms of product development on that front?
Yeah.
Yeah, sure. So, I mean, really, it's the interest rates are really the driver, right? So, I mean, and on two levels. Number one, obviously, when interest rates rise, bond prices decline. Normally, that's not a problem if you get stocks and bonds moving in different directions. Historically, that's been the case. 2022, you saw that kind of perfect storm where they're moving in the same direction.
Hmm.
And then as equities have climbed over the last couple of years, bonds haven't necessarily participated, and some of the multi-assets have lagged. That said, markets change over the last few weeks. You've seen bonds rally, you've seen multi-asset do better, and you've seen interest rates come down. So there's that whole interest rate element in terms of the stock bond correlation. But I think it may look a little bit differently going forward. By that, I mean, if you look at the original reason why we went with very low volatility target and multi-asset indices, is because rates were so low that carriers did not have the budget to be able to offer the types of participation rates and an attractive enough product. So by squeezing that volatility down, you could get a better rate, but you're also loaded up on bonds. So as you have volatility targets come up, you get naturally a higher allocation to equities because equities are more volatile. So I think what you'll see is, unless you think we're going back to zero interest rates, and I don't think we're doing that, we may have
Right.
a decline, but I don't think we'll see that post global financial crisis environment anymore. You'll tend to see a little bit more higher volatility targets, but are still multi-asset. So it could be 7, 8, even higher. I mean, we just launched one a week ago with Invesco for Aspida, the Invesco QQQ Growth. It's primarily an equity story, but it does have a dynamic bond component to help the pricing and smooth it out a bit. So I think that's going to be more of the trend, a higher volatility target with more dynamic elements in fixed income, not just sticking it in there and hoping for the best, but really making it more adaptable to, like I was saying, what the market's going to do.
Personal question. So, out of curiosity, what's like the sweet spot? So, where interest rates have to be in order to be feeling a little more favorable to actually generate it's so to price the product, but competitively enough to use that vol controlled index that might be closer to 10% or higher. So where does the interest rate environment have to be to do that, as opposed to you just feel more comfortable in a 5% vol controlled index?
Yeah, I mean, there's a rate at which you look at getting 50 or 60% in the S&P 500 with nothing on it is perfectly fine, right? Or there's a cap that's attractive at 10% or 11% like that. So if you look at the 10-year yield, it seems like to us like in that 3 to 3.5% range, you start to get where maybe that 38% par rate is not looking that great, or maybe that 8.5 cap is not what I was looking for, and I want a little bit more diversified offering, and I can get a good result out of a multi-asset. So we're kind of getting close there. I mean, rates have kind of come down. Like I said, I don't think we're going down to 1.5 or 2, but even in that 2.5 to 3.5 range is still pretty interesting for some of the volatility controlled ones, especially the ones coming out now that, like I mentioned, have a little bit more of a modern, like adaptable design using intraday data and using more dynamic fixed income components.
Fascinating. So basically 3 to 3.5% for the let's say 10-year treasury. So when looking at that would be a sign that possibly those vol indexes that are closer to 10, they're fairly very still competitive. But once you see the 10-year treasury go down less than 3%, you could possibly see more favorability in a smaller vol control environment. Is that?
Well, I think just the vol control environment in general. I mean, even at a 7 or 8 or 10% volatility, you can still get a pretty good par rate at a 3.5, 10 years. So I think it's kind of in the middle where if you see a 7 or 8% now, is that going to be out of date in 2 years because the 10-year is 3%? I don't think so. I think you're going to get a pretty good range where it looks pretty good. I'm just making up a number, but 75, 80% of this index at X volatility, 7 or 8 is still going to be pretty attractive.
Good stuff. Well, sorry, a little detour, but
Sure.
just out of curiosity, that was good. So what's y'all's what's Salt Financial's secret sauce? So you got the data, but what's Salt Financial's, what do you think attributes to some of the success when it comes to picking winners?
I think it's two main drivers, and it's not picking winners. It's putting ourselves in a position to kind of react and be able to to adapt to what's going on in the market. But number one, it is that intraday data. I think a lot of advisors have heard a lot about this in the market. There's been the FC indices. There's been intraday indices by a number of banks. We've done a number of them with the same banks that we partner with, but they kind of come in different flavors, and we kind of split it up into kind of 3 buckets. The first would be intraday rebalancing, which is basically the rules allow you to adjust exposure every 30 minutes or 60 minutes during the day. A second kind of bucket we consider more of the intraday momentum, where the rules allow for the index to buy and sell, usually futures intraday, but close out the position, looking to take advantage of momentum. And then there's 3 what we do, which is more historical intraday to be able to forecast volatility going forward. Sometimes we're using all 3 of those. Sometimes we're using 2 of those. So there's different features in there, but the one that we do, that historical intraday, I think is pretty unique to us. We built all of our one-day forecast around that model, and that's the one that's most unique to us. The second part, I think, and I mentioned it earlier, is just the fact that instead of coming out with our own brand, and this is what we have, and this is what we are, by being able to partner, we have somewhat of a network effect of being able to work with all these asset managers and index providers to kind of use different strategies and benchmarks and put those in different combinations. So that we consider a pretty big advantage for us to be able to work with lots of different types of people.
And I think we talked a little bit before this one aired. I think right now the NASDAQ, it seems like the S&P too, a very volatile time frame, but maybe some of your data going to you. So based off the last week, so it's roughly August 5th right now. So it's a pretty bad day in the market itself for both those indexes. Is there something over the last week that something the data is seeing that maybe y'all's team notices, or any trends from previous past performance?
Yeah, I mean, over the last month, you've seen volatility a little bit closer to its long-term average. The S&P 500 over its life, it's about 18% per year is the volatility. We've seen it, get up into the high teens and low 20s over the last, month or so. In the last week, like you mentioned, it's been more. Early August, we've seen a little bit more of a sell-off. You've seen it higher up into the kind of 30, 40+%, and that can be very short term. It can come in a few days later. But it's, looking at it historically, nothing like we saw, during the early COVID period. We've seen a couple of these kind of periods before. But to answer your question, yeah, we tend to see it a little sooner because we're picking that up. Yesterday's forecast is really the most sensitive part of tomorrow's, and we're able to pick that up and bake that, and project that forward and adjust exposures accordingly. So it's definitely a bit of an advantage to be able to use that intraday data as opposed to relying on just the closing data.
Love it. And for those that don't know, so truVol, can you elaborate on that? So that's what y'all are known for. So what exactly is that?
That's our main forecasting engine. We kind of describe it, it's a forecasting engine and a kind of set of tools. So the forecasting engine is kind of what I've been talking about, using that intraday data. We forecast 1 day forward, and we also forecast the trend, very short term, over the next few days. Is volatility likely to increase or decrease? And then we adjust the equity accordingly. Those are kind of the two core pieces. Around the edges, we have other things that are able to adjust the volatility to help the pricing, to be able to make it tighter so that the dealers can offer a better price. Ultimately, that leads to a better par rate. So some of those tools we have kind of built in. And then we worked a lot with the banks on, well, how can you price it better if we tweak it like this? So we built this kind of standard toolkit that you can adapt to almost any index, multi-asset or equity only. And it really is using a lot of ETF data to power it. That's where we really use a lot of, SPY, QQQ, sector spiders. These products have been around for 20 years and have a ton of data. And there's a lot of information in that data. So that's really what drives a lot of the forecast.
With the new one that just launched, you've referenced it, I think, once or twice now with the QQQ within a SPIDA that recently launched. Is there anything that y'all have, so as advisors start to hear a little bit more of y'all's brand, Sol Financial, truVol, is there anything on the horizon this year that the listener can maybe be, have a sneak peek of?
Yeah, so a couple things. I mentioned we have 10 indices so far. We have several more slated for launch in the back half of 2024 and early 25. You'll see some more NASDAQ ones, but you'll also see some more with asset managers and banks as well. So we're still maintaining our mix across partners. We're doing some equity only. We do have some multi-assets coming as well. We have some with commodities coming out. So these are the ones that are kind of scheduled for launch. I'd also say we're probably going to have more partners come aboard. So hopefully we'll have something announced too. Another brand and set of benchmarks and strategies that we work with to introduce more into the market. Those are the two things that I'd highlight.
Thanks for sharing that. So cool. So more indices coming out. Currently 10. I know there's about, I think 3 or 4 carriers, right? Or even more that y'all are currently located
Yeah,
on?
we have, let me think, 1, 2, we launched 2 with the SPIDA. And I think we have another 8 carriers. So they're they're all over the map. We have a number of carriers on board. I think it's just the SPIDA with the 2.
Yeah.
But yeah, we'll have new carriers coming too that have partnered with us.
Good stuff. So I appreciate your time as we're wrapping up here. Is there anything we missed or anything you wanted to share with the audience before we close out?
Yeah, one thing to mention, we produce a monthly index report on all volatility controlled indices that we distribute to the industry. What we do is we adjust all the indices. So if you have a 12% volatility target, you can compare it to a 5% because we adjust it all to 5 and put everything on an apples to apples. So all you can look at the year to the date or the 3-year, the 5-year, and you can compare them, just by looking at the returns. It's available on our website at solfinancial.com under the data analytics, and it's free. So we can email it to you every week. It just actually came out today on August 5th. So we do it every month. The first week it comes out.
And so anybody listening to this, they could just go to solfinancial.com and they just go to the website.
Yep. Click on the data section and that'll be the index analytics. And you can subscribe right at the bottom of the page.
Data, especially in this industry.
Absolutely.
So that's good stuff. I appreciate your time, Tony. And also thank you to the listener for tuning in this week. Don't forget to subscribe on your favorite listening device and leave us a review on our current podcast. Feel free also to follow us on LinkedIn at Jeremy Hauser and on our YouTube channel. Subscribe to us at Jeremy Hauser AMP for additional weekly clips. And in closing, and as you share this episode and content with a colleague or a friend, just remember, in a world full of betas, be an alpha.